All right, let's now take a look at what's going on at an equity level. And James Gerrish now joining us from Shaw and Partners and Market Matters. James, good to see you there. Of course, on local markets, in fact, on Wall Street, we did see it lost momentum quite rapidly there. Look, investors obviously spooked by what's going on in the UK with the intervention of the BoE. But also ahead of that key inflation report later this week out of the US.
Yeah, good morning to you, Andrew. Yeah, a lot of moving parts in the market at the moment, and that sort of shone through at the back end of the overnight session. As you rightly point out, the market fell away pretty sharply at the end. I mean, the UK has been the source of a lot of this volatility. They, obviously intervened in the bond market. Now they're saying they're going to pull back from that intervention. Um, you know, the bond market was extremely volatile. The currency market was also extremely volatile. So, look, I think there's once we get a bit more clarity coming out of US inflation numbers due out on Thursday, I think the market can probably take stock and see how to position from there. Higher inflation, I think the market obviously trades lower on the back of that weaker inflation. So the headline rate at 8.1 or lower will probably be met by some buying and a reduction in US bond yields, which are really the key at the moment for the market's direction.
All right, but just in terms of those credit spreads, what do you think? We're not at that alarm level as yet.
Yeah, so I guess there's two things at play in terms of the cost of capital for corporates out there. So we've all seen that bond yields have increased. So US 10 years are nearly at 4% now. But we've also seen an expansion in credit spreads. So 12 months ago, non-investment grade credit was trading around 2.3 over. It's now trading around 5.3 over. So obviously it's going to increase the cost of capital. It's going to create a greater hurdle for investment decisions to be made, and ultimately it reduces growth, if you like. So, that's the backdrop, but it's not. You can see on the chart in front of you around what was alarming levels. So, obviously during the pandemic, credit spreads got up to 10%. You go back in other years, GFC, it was significantly higher than that. So we're at high levels, but not, as I say, amber rather than red levels in terms of the credit markets.
All right, and then, that's the next chart there as far as the investment grade spreads are concerned.
Yeah, these are the higher quality borrowers, so obviously they pay less for capital. They're trading at 136 over, which is about half what it got to during the pandemic. So during the pandemic, they spreads blew out to about 260 over. So again, we're probably at amber levels, but not yet those alarmingly high levels.
All right, so obviously that's something to keep an eye on. James, what else are you looking at the moment, I guess, given what's going on globally at a macro level, but also locally? Any particular drivers? Because we are heading into reporting season out of the States, so that's going to be interesting in itself. What about locally?
Yeah, it is. We were just talking about on the desk here, just around the influence that the macro environment is having on stocks. It's almost overshadowing corporate news at the moment. That said, Bank of Queensland's out this morning with their full year results. They came in slightly lower than expected in terms of their cash earnings. So cash earnings at 508 versus 517 million expected. So it's about a 2% miss, but there was some more upbeat commentary in their results. So net interest margin was 1.75%. Their costs were flat on FY21, which is probably a good result in this sort of environment. And they talked to, they're setting out their big plans for the future, the digital bank and the like that they're moving through. But like just brushing through the results, I mean, it was a reasonable set of forward-looking statements. I think the FY22 cash earnings result was slightly lower. The dividend of 24 cents was up on 22 cents for the first half, but I'd also, that's a 46 cents dividend for the full year. You look at that on a 707 share price, you get about 6.5% in terms of yield. You gross that up for franking, you get 9%, and it's starting to look, reasonably attractive given where it's trading at the moment.
All right. And what it's looking was the integration of the ME Bank as well at this point. What more broadly, how does BOQ fit in that broader financial sort of sector?
Yeah, you make a good point around ME Bank, and one of the things that was highlighted in this result today was just around the synergies that they're achieving through the integration. So they had a better outcomes in terms of synergies, and they've upgraded their expectations around those slightly. So that would be a positive that I'd call out there. I mean, I think Bank of Queensland's this. It's it's the cheapest in the space. There's no doubt about that, but it's got some challenges moving forward. So it's on an old technology stack that they're trying to rejuvenate. It obviously has smaller customer base, smaller earnings, and the like than the others. So it's got to be very smart around how it rejuvenates its technology stack to remain competitive with the other banks that are spending a lot in this area. So, CBA is the most dominant, best in the space, really strong technology stack, but trades at a massive premium. And Bank of Queensland is probably the other end of the spectrum. So it's the cheapest, but with worse systems. But they are, trying to improve those, and they are working on their strategy out to FY24. And they're integrating ME Bank, and they've obviously got Virgin as well, which is a differentiated brand in the stable.
James, you looking anywhere else at the moment, I guess at a sector level, or are you just sort of sitting, waiting, particularly to see what plays out at a global level?
Yeah, I think the major thing. So, if I think about the market, I think over the next 3 months, I think our view is the market trades higher on the back of central banks taking their foot off some of the, taking their foot off the neck of the market, if you like. So obviously, central banks have been really aggressive in the way they've hiked interest rates, and that's having a really big impact on valuations. Bond yields go higher, equities go lower. I think that starts to turn, and that's why we're positioned more favourably into the back end of the year. That said, the CPI print, I can't stress it enough, on Thursday night in the US, that is going to be key for our view of the market going into the back end of the year. So if we've seen signs that inflation is easing off, then that's going to be taken really positively. We saw it when the RBA only hiked by 25 basis points, not 50. That change in rhetoric, a slight tweak in the expectations around interest rates, saw the biggest rally in 2 years locally. Yes, we've given some of that back, but it shows you how the market is negatively positioned and is susceptible to really strong rips on the upside. So that's what we're positioned for, Andrew, at this stage.
But you're not willing to take a bet before that number drops, then?
I mean, yeah, we're invested, so we're taking a bet
Yes.
every day in terms of the market. So, we've slightly, we've gone from a higher cash position to a lower cash position. So we're banking on that view that inflation has peaked and is going to continue to track lower. But it's clearly a risk, and markets are about reacting to any change in information and resetting portfolios accordingly. So, if the US inflation print is more significant than we expect it to be, that'll force us to reset our portfolios as a consequence of that.
All right. Are you seeing any sort of compelling value, particularly tech? Speaking to a number of portfolio managers, particularly in the States, they're saying it's pretty irresistible at the moment. What about locally?
Yeah, I mean, buying a stock that's got, or a company that's got better fundamentals but is down 50% from their peak is, it's compelling. You look with the, Harry hindsight, I'll tell you that obviously valuations were too high, and now we've gone into more palatable valuations because of what interest rates have done, and I think that's a fair comment. I mean, technology is an area that we've started to skew our portfolios, but also there's, in the US, there's other areas that have been negatively influenced by higher interest rates. So something like, some of these big alternative asset management firms, the big PE firms. So Blackstone is a company we've just bought in the last couple of days, international portfolio. That's down substantially from its highs. Obviously, higher interest rates are a real impediment to getting deals done. The hurdle rate goes up, but that is, that is now priced in a very, very weak environment moving forward in our view. So we've gone in and bought Blackstone the last couple of days, and yeah, you're rightly so. We have moved higher into our technology allocations. I think Sean was on the program earlier this week just talking about real estate, REA Group, I should say, and Seek. They're high quality growth companies that are down 50% from their highs. So we've started to add some of those into our growth orientated portfolios, Andrew.